XRP just hit a number nobody expected. Not a price number, something quieter, something that usually gets ignored until it's too late to ignore. Blockchain analytics firm Santiment just flagged something on the XRP Ledger that hasn't happened in roughly 12 years. Average trading returns across the network have collapsed to their lowest level in over a decade. And when a metric like that breaks a 12-year pattern, it tends to mean one of two things. Either the market is broken, or the market is about to reset. Right now, a lot of XRP holders are sitting on losses they don't like to think about. That's not speculation, that's what the data is showing. And historically, moments like this one haven't just come and gone quietly. They've often marked turning points. Not always, not guaranteed, but often enough that serious analysts are paying attention. So the question isn't whether this number is real. It is. The question is what it actually means, whether it's the setup for a relief rally, and whether XRP holders should be watching this closely or ignoring it entirely. Let's get into it. Right now, sentiment across the crypto market is mixed at best. Nobody's popping champagne, but nobody's fully panicking either. It's that uncomfortable middle zone, where prices have been weak for a while, confidence has eroded, and investors are quietly asking whether the bottom is already behind them or still ahead. That's the backdrop this sentiment data just dropped into. And context matters here, because a 12-year statistical extreme doesn't mean much in isolation. It means something when you place it against a market that's already exhausted, already uncertain, and already looking for a reason to move. That's exactly the environment where this new report is starting to spread. Santiment's data centers on something called average trading returns, a metric that essentially measures how profitable the average XRP holder currently is based on when they acquired their coins and what those coins are worth now. When that number falls this low, it tells you something specific. It tells you a large share of XRP holders are underwater, not slightly down, underwater in a way that hasn't been this extreme in about 12 years. Now here's where it gets interesting. This is the strongest piece of evidence in the whole story, so let's slow down on it. Santiment's report doesn't just say returns are low, it frames this as a rare on-chain signal, one that historically has, in some market cycles, preceded periods of stabilization or recovery. Cointelegraph picked the data up and amplified it on X, which is part of why this conversation is spreading through crypto circles right now. But, and this matters, nobody credible is calling this a guarantee. Santiment's own framing is careful. The data shows a pattern. It doesn't promise an outcome. Historical on-chain patterns can fail, and similar conditions have not always resulted in meaningful price recoveries. So why does a 12-year low in trading returns actually matter to someone holding XRP right now? Think of it like this. When most holders are sitting on losses, a lot of the weak hands, the investors who bought impulsively and panic at the first sign of trouble, have often already sold. What's left is a market with less remaining selling pressure, because the people most likely to panic sell have frequently already done so. That's the mechanism behind a relief rally. It's not about new buyers suddenly flooding in. It's about the exhaustion of sellers creating room for price to move upward, even temporarily, once sentiment shifts even slightly. That's a meaningfully different story than the market is turning bullish. It's more precise than that, and precision is exactly why this data is worth paying attention to. Based on what the data shows, here's the reasonable read. Depressed profitability at this scale has, in prior XRP market cycles, sometimes lined up with periods where selling pressure eased and price found footing. That's a pattern worth watching. It is not a prediction. Nobody serious is treating a single on-chain metric as a crystal ball, and neither should you. A relief rally, if one happens, would be a short to medium-term recovery, not automatically the start of a new sustained uptrend. Those are two very different things, and conflating them is where a lot of investors get burned. So what would actually need to happen for this signal to translate into real price movement? This is where it's worth zooming out from XRP specifically and looking at how relief rallies form in general. They tend to need a combination of factors lining up at once: selling pressure decreasing, sentiment improving, short positions getting closed out, and buyers stepping back in because valuations start looking attractive again. None of those factors exist in a vacuum. They're not just about XRP's chart. They're tied to bigger forces, monetary policy decisions, regulatory clarity, institutional capital flows, and the overall mood across digital assets as a category. That's the piece that often gets lost when a single data point goes viral. The metric itself is real and worth watching, but it doesn't operate independently of everything else happening in the broader market. Here's the bigger picture forming underneath all of this. On-chain data like this has become increasingly central to how serious investors evaluate crypto markets, arguably more central than it's ever been. It's not just about watching price candles anymore. Metrics like holder profitability, wallet behavior, transaction activity, and capital flow patterns are giving analysts a window into market psychology that price alone never could. And that shift matters for XRP specifically, because the XRP Ledger has been operating long enough to generate the kind of historical data that makes 12-year comparisons even possible. That long operating history is part of what gives this signal weight. You need years of data to identify something as statistically rare as this. At the same time, XRP continues holding its position as one of the largest digital assets by market capitalization, with an ecosystem still built around cross-border payments, liquidity infrastructure, and enterprise blockchain use cases. That foundation doesn't disappear during a drawdown. If anything, periods of depressed profitability are exactly when the difference between projects with real infrastructure and projects with none tends to become clearer. None of that guarantees a rally, but it does mean XRP isn't just another asset showing a statistical anomaly. It's an asset with enough history and enough infrastructure that the signal actually carries analytical weight. Zooming out even further, this fits into something larger happening across crypto right now. Investors, both retail and institutional, are increasingly layering on-chain analysis on top of traditional technical and fundamental approaches. Nobody serious relies on a single indicator anymore. Not price, not sentiment, not one on-chain metric in isolation. The smarter approach, and the one most experienced market participants actually use, is combining several lenses at once. Technical indicators, on-chain metrics, fundamental developments, liquidity conditions, macroeconomic backdrop. When several of those start pointing in the same direction, that's when confidence in a thesis actually increases. When only one does, that's a signal worth watching, not a signal worth betting everything on. That's exactly where this Santiment data sits right now. One strong, historically rare signal, not yet confirmed by everything else around it. So where does that leave things? Santiment's finding is genuinely notable. A 12-year low in average trading returns on the XRP Ledger isn't a small statistic. It's the kind of data point that historically has, in some cycles, shown up right before conditions started shifting. That's why it's spreading through crypto media, and why Cointelegraph's amplification of it only accelerated the conversation. But the responsible takeaway isn't get ready for a rally. It's watch closely. Depressed profitability creates the conditions where a relief rally becomes more plausible. Reduced selling pressure, exhausted sellers, room for sentiment to shift. Whether that potential actually turns into price movement depends on everything happening around it: liquidity, macro conditions, and whether broader market sentiment starts improving alongside this signal rather than in spite of it. That's the story to follow from here. Not the headline number by itself, but whether the rest of the market starts confirming what this one metric is suggesting. If you found this breakdown useful, drop a like, subscribe if you want more of these deep dives into what's actually happening on-chain, and let me know in the comments, are you watching this signal or waiting for more confirmation first?